Hard stop versus trailing stop. Most traders treat stop losses like optional seatbelts. But can you imagine a basketball coach who never calls a timeout, even when the opponent just went on a 15-0 run? That's exactly how traders blow up accounts. Today I'm handing you two timeouts that protect any portfolio, the hard stop and the trailing stop. And I'll show you when each one wins the game. Let's get right into it. Around here we turn hectic, emotional trading into championship level execution. If you've ever moved a stop, missed a slam dunk profit, and watched the scoreboard flip against you, buckle up, this playbook will change your season. First, the hard stop. Let's picture the baseline on the basketball court. The moment the ball crosses that painted line, play halts, no debate. The referee blows the whistle, he stops play. A hard stop works the same exact way. Price taps that preset level and you're automatically out. The hard stop is your instant safety valve. It's great whenever a stock suddenly becomes jittery, so a sharp drop won't wipe you out. The downside, a 1 cent fake out can bench you before the real rally starts. So you'll be on the sideline, you'll be taken out, you'll be set on the bench, and then next thing you know, you watch everyone else go up and the score runs up 30 points, everybody's cheering, and you sitting on the sideline. But that's the price of absolute protection. You may not go up and be a part of going on a 30-point run, but you also, in case you was to go down by 30, you're protected as well. Now the trailing stop loss. Think of a defender, Pat Beverly, Gary Payton, all these defenders that's known for great defense. This here, they shadow the ball handler coast to coast, so that you stand very close to it. That's the trailing stop loss. Always 3 feet behind. As price moves in your favor, the stop moves too. So as price moves up, go up 3 cents, $3, your trailing stop goes up as well with that. Locking in gains while giving the play a little room to develop. It's fantastic for strong trends and terrible for choppy trend. Crossover heavy market where you get juked out and stopped early. Let's run a no chart example you can double check right now on any phone. Picture Ford Motor Company, ticker symbol F, trading at exactly $12. A hard stop 50 cents below at $11.50 means you're risking 50 cents per share, period. It's that simple. Set a 4 cent trailing stop loss and it starts at $11.52. Then ratchets upward every time Ford climbs. Scribble those numbers on a sticky note and you'll see how clearly the math works. No fancy software required. When should you choose each option? Quick scalps and low float, names demand a hard stop. Fast break, step out if you lose the dribble. Swinging a trending ETF over several days, use a trailing stop loss to protect the lead while the clock runs. Are you gambling on an earnings gap? Keep it simple. Hard stop, short leash, one foul and you're on the bench. Here's some rookie mistakes or rookie fouls to avoid. Never slide a hard stop loss lower. It's like widening the rim mid-game. Don't set a trailing stop so tight that every routine and basic crossover knocks you out or breaks your ankles. And always check your time in force. An older linger than after hours can wreck tomorrow's opening tip-off. Here's my 4-point safety checklist. Risk no more than 1% of your account on any trade. Place the stop before you enter the trade, so you know how much you want to risk before you even enter the trade. Size your position after you know that stop distance, not before. And only switch on the trailing stop loss once that trade is at break even or even better. If you save stress or cash, drop a red stop sign emoji in the comment. Slam dunk the like button, hit subscribe, and see you guys in the next video.